The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's discuss the practicalities of trading style with practical risk aversion. Okay, and the question I would like to pose here, we're going to walk through a bit of a case study, I suppose. The question I would like to pose to our students online here is: do all traders share the same appetite for risk when trading the financial markets? Do all traders share the same appetite for risk when trading the financial markets? Well, here we have a risk aversion sample test. Okay. So bear with me, and we can enjoy this case study, of course. 3 individual traders working in a proprietary trading firm are told to go and develop a risk-averse trading strategy that will develop over a minimum 5% return over the course of the trading day. Okay, the task at hand, guys, is to develop a risk-averse trading strategy that will develop a return of 5% over the course of the trading day. Difficult enough task, is it? Well, each trader is provided with a €1,000 trading account. Okay, so we've been provided with a €1,000 trading account. Each trader is asked to place 10 trades only over the course of the trading day. Okay, so we've been asked to place 10 trades over the course of the day, each of these 3 traders with the €10,000 account. The monetary return for the risk-averse trading strategy must deliver a minimum of €50. Okay, so we have our objectives in sight. Let's see how they performed. Okay, so the end of the day trading performance, guys. The question I would like to ask here is, which of these traders is the most risk averse? So let's go through in some detail here how we got on. Okay, so these are the instruments traded here. They've chosen all to trade then the US dollar CAD. You can see the monetary exposure for trader 1 is succinct. In fact, it's succinct for all of them here. We have €10 to the downside, okay? €10 or dollars or whatever to the downside effectively as a monetary stop loss, okay? Now what we can see with trader 1 is effectively he is doing well at the start. He's outperforming the market. Okay, so we have a winner, small loser there, a winner, small loser there, and again he's actually cutting some of his losers short and not letting his total monetary exposure or stop loss get hit. Again, some very good trades here, and that is fantastic trading. Wouldn't you agree, guys? So this guy has actually looked to trade the markets, guy or girl, of course, trading the markets, and has effectively delivered a return of 66.76 euros. So he's beat the threshold. He has performed very well. However, the other traders have also performed very well here again. Okay, so we have a fantastic winner there with the monetary exposure, again succinct at the 20 mark the whole way. However, as you can see, we have some fantastic winners with this guy. Some losers are actually below the stop loss or above and beyond the call of the stop loss, so that indicates poor risk management, of course. And we'll just change our color for this guy. So of course some poor risk management here, and again here, okay, some alarm bells are going off with this trader, and again we have a poor trade here. So effectively this trader has, of course, let's not be too harsh, he has outperformed the market with a task of 5%. He has performed well. And we move on to trader 3 then. Again, the monetary exposure with a €1,000 account, he's decided to use €30. Okay, so he's perhaps trying to outperform. So again, €30, it's of course a 3% trade on each particular trade he's taken, and effectively he is, as you can see, it looks like he's running a negative risk reward ratio at minus 2 to 1. So effectively a negative 2 to 1 risk reward ratio. His losers are of course his stop loss, which are of course the the full 30 on his stop loss monetary exposure. So that's okay. We can actually tick these. And his winners are, of course, not even less than, of course, given the volatility in the markets, he's actually fulfilled all his trading obligations. And of course, his winners are 15. Now, he has delivered a return of 60, which 60 euros or dollars, of course, he's been given a euro account. So 60 euros, and he's effectively outperformed the market again. So three completely different trading strategies, okay? So the question, guys, was which of these traders is the most risk averse? Well, what do we think, guys? Trader one. Most of us are saying trader one. There's a few trader threes in there. Yeah, guys, to be honest, there is no right or wrong answer. If I was to honestly give you my opinion, I would argue that trader three is the most risk averse. Now, he's the most risk averse in terms of what he's been asked to do, simply because he has been asked to develop a risk averse trading strategy. Now, he's running a 2-to-1 risk reward strategy, but if it's working, guys, it depends on the markets that he's trading, of course. If he's trading the forex markets, there's more volatility in there. You can see it's most certainly a trading strategy. That's the first thing I would say. Trader 2 is performing well. He's underperformed the three guys, but he still beat the market there, or beat expectations of 5%. However, you can see he is effectively at times not following through with his trading strategy, most notably his two losers that are over his stop loss account. So that would tell me that trader 2 is not following his own strategy. So if I was his boss, of course, I would be looking into his trade sheets in a little detail. And trader number 1 here, what we have is a very consistent, very well performed trading strategy. He has at times, let me see, yeah, he's always stuck to his monetary exposure. At times he's actually taken losers a little early, so that's fine that he's cutting his losers short. This tells me, however, that trader 1 is actually a very, very skilled trader, very skilled trader, and his skills might not necessarily be down to his trading strategy. They may be down to his market selection, or he perhaps is a very skilled trader himself. In terms of following a risk-averse trading strategy, you could argue trader 3 has done effectively what he's been asked to do, and he is outperforming the market with a very well-used strategy. Now, let's go into some more detail here. Again, we bring back the test. The bosses are delighted. All three traders were able to develop a return over 5% on their trading account in a single trading day. With such delight, he's asked for the traders to develop on their performance and inquired about their trading edge. The three traders brought their full trade sheets to the boss for closer inspection to clarify how they exactly had made their money. So let's go back in and see how they get on. Okay, so first thing that we noticed, guys, was that in trader 1's sheet, of course, he had placed the markets that he had traded. Now they've all been asked to show more detail, of course, and we can see effectively how these changes have been made. So again, we can ask the same question, guys. Which of these traders now would you say is the most risk averse? And we'll walk through it together, okay? So with the full trade sheets in motion, guys, which of these traders now would you say is the most risk averse? Okay, well, let's go through it in some detail here. Well, we have, of course, trader number 1. He has chosen to trade many different assets. We have dollar CAD, Bitcoin, copper, UK 100, which is the FTSE, the Amazon equity, single stock equity, dollar index, the US dollar against the ZAR. Okay, so a very well diversified portfolio. Remember, guys, this trading was all asked to be done in one day with 10 particular trades. Okay, now as we move across to other asset classes here, you can see with trader 2 has chosen to trade, it looks like he's only traded the forex pairs, okay, and he has, of course, traded euro against the Aussie dollar, the pound against the Japanese yen. Okay, so effectively the euro pound, yep. Okay, so he has, of course, albeit he has some risk management in there in terms of mitigating risk with market selection. However, he is still trading some of these pairs again. So within this one trading day, he has 1, I'll actually choose a different color of pen just to highlight this in some detail. So what do we have here? We have, let me see, dollar related pairs. We have 1, 2, 3 with the euro dollar, 4 and 5. So $5 related pairs across those assets, okay? And again, a couple of euro pairs here as well. So let's just go through this in some detail. We have 1, 2, 3, 4, 5. So it's starting to become more and more clear, guys. This isn't a consistent trading strategy from trader number 2. He has, taken some losses over and beyond his monetary exposure. He doesn't have the knowledge to trade different asset classes, and you would suggest that he's been trading many of these different markets at the same time as well. So that would say why some markets that he's probably in some of these same trades at the same time. Of course, he's had a fantastic winner in the euro pound there, 45, which is double the amount of his monetary exposure. Fantastic trade. However, he's also taken a loser there later in the euro pound as well, which you can see. So the guy simply isn't following a trading strategy. Looks like he's scalping and getting involved and not delivering a level of consistency that would interest his bosses, I would assume. Now we go on to our preferred previously trader 3. Let's see how he got on. And what we can see, guys, is initially that he has traded all the forex pairs. Okay, let's look into some detail. And of course, the thing that sticks out here, guys, you're all commenting on it. He's traded all dollar pairs, so there's absolutely no diversification in here. He has overcompensated with risk. It is not a risk-averse trading strategy, and we can say trader 3 unfortunately does not cut the mustard. Looking through, he's got dollar yen, dollar CAD, euro dollar, the dollar index, euro dollar again. Let me see, US dollar CAD, US dollar yen again, pound dollar or cable market, dollar yen again. Okay, now there might have been fantastic moves in this market today, and that is why he's chosen to trade the market. So this trader might be a very skilled trader indeed. I'm not saying that. He's looked across the assets to try and say, how can I trade? How can I deliver a return over and above 5%, which is the 50 euro mark requested by his bosses. He simply looked across a market that is moving. Of course, the US dollar could be very strong at this period of time, and he has traded as such. Now, he has, of course, kept his monetary exposure. So if he's able to explain this to his bosses, they might look at this with some jest, I suppose, in terms of assuming it as a trading strategy. However, the point of the exercise for these traders was to define a risk-averse trading strategy. And what we can see effectively, guys, trader 1 gets a big green tick because he's traded many different assets. He has kept his monetary exposure with stop loss. He has even cut some of his losers short and let some of his losers run. So, and he's obviously developed the full return of 66.76. So he is our winner of the day. Trader 1, you can see trader 2 has broken many rules. Of course, when you start breaking rules in trading, your own rules, well, your trading strategy, you might as well throw it out the window. So that's a big no. And again, trader 3 is performing fantastically in the market. Now, his monetary exposure has been fantastic. However, there's alarm bells going off here with the exposure to the dollar across every single trade that he's been in. So he might have just hit lucky on this one day. Of course, he might be skilled as well, but that does not focus in on a risk-averse trading strategy. So for trader 3, we can say no, and we'll choose, of course, our preferred trader 1. So can you see, guys, how I'm making the point there, just with market selection, with practical risk aversion, with many of these ideas on stop losses and monetary exposure, how we look to capitalize on these risks and how we look to mitigate these risks, that evidently there is trading opportunity there for us. But what we want to do is to develop a risk-averse trading strategy. Now, this lies in market selection as well. Market selection is not only important in finding those qualitative trading opportunities, it is crucial to choosing the best risk to reward ratio trading opportunities. Okay, so what are the best risk reward trading opportunities in line with the current volatility and with your own preferred trading style. That is how we look to choose markets, guys. Not simply because, well, I'm in a dollar pair now, I cannot trade that, I'm going to trade something else because I simply can't trade the dollar. No, we look for the best trading opportunities that suit our own trading style and assess the current market volatility. In financial markets, volatility is risk, especially if you're an equity trader. What I mean by that is when there is generally volatility, it is to the downside in the equity markets. When uncertainty and fear comes into the equity markets, causing volatility, where do the markets head? They head south. So that is just a comment there. We can seek less volatile markets in an effort to develop perhaps more sustainable risk-averse trading strategies. And that's, guys, that's what we look to do as traders. So let's look at a market here in front. Just the question again, does this market volatility suit your trading style? Now, why would I ask this question? Why would I ask, does this market suit a volatile trading style? Of course, because I would say this is a relatively volatile market. Again, we are looking at the 4-hour candlesticks for the US dollar against the Swiss franc. You can see, guys, effectively from these highs to roughly around the lows here, albeit we're around lows now, guys, the volatility has been quite substantial. It has only traded perhaps a 99s to 104, so it hasn't traded a huge amount. It's trading within this range perhaps, but the volatility in getting involved in these opportunities is quite big. You can see from each particular candle, it moves from here to almost 3/4 of the way through the range. The next day it's moving from high to low, and then from lows to highs again in relatively short periods. Look at this candlestick here, another one. So there's quite substantial volatility. It's red candle after green candle, and quite difficult to trade as well over the long term. So this might not suit your trading style. It might not suit your market selection. If that's the case, I would say forego the opportunity and focus in on something that does suit your style. Again, another market here, we have the US oil. This may be more suitable to you. And the question I would like to pose is, does this market volatility suit your trading style? Now, you can be quite honest with me, guys, here. If it doesn't suit your style, there are markets that I don't trade. I can say I don't like them, but it's probably because I don't know how to trade them. And I just don't, because there are easier trades, I feel, out there in the market. So this is our oil market, or US WTI market. Now, of course, I do trade this market. It's one of my favorite markets to trade, given specifically now we're in a very large bull trend to the upside, this bull run here, since lows of around $26 per barrel. So we're now around 72.36, so that's great. But is this suited to my trading style? Is it suited to your trading style? Well, of course, it depends how you trade it. Of course, I would like to suggest it is, because for me, of course, it's in a trend. There's some volatility in this trend, but these present actual opportunities for me. When I see something like this with a huge rejection to the downside, that is a buying opportunity for me, of course. When I see the market just pitter-patter around here, I'm waiting for another signal to let me know we can have a shift away. So we had another sell down here, and again the market rejected these lows with this candle here, looking to follow more momentum to the upside. So there's many different trades you can get off in this market, and again, you have more of a directional bias. You have volatility in there. There are times when the volatility decreases. You can use many different indicators as well as your fundamental knowledge of the market as well. So this is a market that I select, so it's as easy as that, guys. We're looking at market selection in terms of risk aversion. I know, for example, on a fundamental basis, I would be shocked if I get long this market. Now, it can happen, of course. If I get long this market today and tomorrow this market is trading 69s, I would be very shocked. Now, that can happen, but the chances I know of that happening are slim to none. So that is one structure that I feel comfortable with in terms of selecting my markets. In terms of Bitcoin, I don't know much about it per se, of course. I wouldn't have the same level of comfort and wouldn't include it in my market selection as looking to include it and mitigating risk in terms of those less volatile markets. Okay, so let's go through many markets and actually discuss how we look to mitigate risk, because it is much more of a discussion to trading one market at a time. Okay, so What we have on screen here, guys, is again our practical risk aversion. Okay, we're looking to mitigate risk of many of these trading opportunities. So what we have here is something I've chosen, and this is hopefully how you're going to look to start to trade when you're eager to get going in the markets, of course. And what we have here is a wide selection of different markets. We have the German DAX here, the German 30, trading on highs in this period. We have the cable market, pound dollar, trading on relative lows. We have dollar CAD as well, showing some volatility. We have the copper market again, copper daily market, trading up, broken that high there. And we have Euro, Japanese yen, and the UK FTSE 100. Okay, so it's a nice selection of markets. Now, the question I would just like to think, and I'm going to go through some trading opportunities here, is how can we mitigate risk? Because it's not as simple as putting your stop losses in one market and looking across a different asset to say, well, I'm going to get involved in a different asset when the time is right. No. So let's discuss this in much more detail. Here are my entries for these markets. Okay, so let's look at the German DAX first of all. We have the German DAX here to the left. I have a long entry here, so I'm long this market, and my stop loss is below the market. Okay, so it's a simple entry point. We are short the cable market, or pound sterling, of course. We've shorted it here. Stop loss is in a relatively good position there. And we have a long entry here in the dollar CAD as well. So effectively, we're looking to capture some dollar momentum to the upside. As we can see, cable is trading lower as well. As a result, now our stop loss is just at the lows here. So that's absolutely fine. We have a short entry here in the copper market. Again, stop loss above the high. We're fading that market. The euro yen, we're actually shorting this market again. So it's, albeit it's reversed from highs, that may be the decision to get in there. And a long entry here way back when in the FTSE 100 with our stop loss when we entered there. Okay, so that makes sense to us. All vividly good trading decisions so far. Now, again, the question we need to ask when we have 6 open positions is, how much risk are we exposed to? Does anyone ever ask that question when they are in 6 different trades? Now, I know that you can have a rough idea to your 6 stop losses. Maybe you like to count all your stop losses and say, well, I've got a €1,000 account. Each trade that I've taken is 1%. So what does that tell me in terms of my stop loss? It's of course €30 to total exposure. So that is a good exercise to get into. But in terms of natural risk, do you know what your exposure is? So let's walk through what we might do here. Can we mitigate some of this risk? Can we look to mitigate away some of this risks on our account? We have 6 open trades, but the stop losses, we've entered them, some of them quite recently, some of them a while ago. Should we look to mitigate risk on the trade and actually take the overall exposure of our account, which is still now at 30 because we haven't moved the stop losses, at a total 6%? Can we look to mitigate some of that risk away? And the answer is, of course, yes, we can. So we include and move our stop losses up. Now let's go over our trading account. We have a long entry here. The stop loss has been moved up to mitigate some risk. And again, let's just go through our German DAX. Great trade. Then we're short, of course, the pound cable market, the pound dollar, and we moved our stop loss to this little price range here. No change here because we're actually a little offside, just moving to the downside in dollar CAD, so our stop loss is still in place. That's fine for that market. We're exposed to 1%. The short entry here is, of course, just relatively recently within today's candlestick, so there's no change there, but we're happy with that. And the euro yen is the same decision. And the long entry, which was quite some time ago in the FTSE, is effectively mitigated off with our stop loss way and above this price range here. So effectively, guys, what we can see is we have a total level of exposure on our open positions of 3%. Okay. However, because we've moved some of these trades into profit positions, okay, this is of course potentially more than 1%. Let's say this was 2%. Another position would be in better areas as well. We do not have a full 3% on the trade, so we're continuously mitigating risk of the account balance, of course, and of our portfolio. That is how we manage our trading accounts, and that is how we I'd look to always get involved in the markets as we can. Of course, we try and let the good trades run. That is a question for us all, guys. What is our new level of overall exposure? Okay, what is our new level of overall exposure? Well, we discussed already, we have this, we'll go through them individually. This is effectively a +2 trade, +2%, because the stop loss has moved and we've given it 1% exposure for all of these trades. We're now at +2, okay? We have a short entry here and we're now at +1 with the cable market. We are effectively let me just change our color here, effectively still at 1% risk exposure with our stop loss there, and the same is true with our copper market and our euro yen market. Again, just getting into those two trades today. Okay, and then so that effectively gives us a qualitative assumption of risk on our account of exposure at 0%, albeit we need to consult our final market here, and we have effectively made a fantastic trade in the FTSE 100, and this is our 1%, and we have effectively gained 3% in this trade if the market pulls back to get us out at these levels. So that's a +3%. So effectively, guys, the exposure on our trade we can mathematically say is +3% on our account. Okay, so obviously we're not totally sure what's going to happen in these other trades, but if we take losers on these trades, if we take losers on these trades, okay, and the markets pull back, the markets that we have performing well for us, we are going to grow our account by 3%. So we have no exposure in terms of overall account exposure on our account, mitigated across different markets. That is how we effectively develop portfolios. That is how, guys, we look to mitigate risk across different markets as well. Okay, so it's very, very simple to do. It's very simple to interact with. You're going to get better at it across time. Do think of the monetary exposure for your trades. Think about interactively or proactively getting involved in mitigating these risks, and start to journal, start to monitor your risk assessment as you move through the markets and through your trades. Now, to finish off, there is some, I suppose, asymmetric information in terms of realities to risk. In dealing with gains, people tend to be risk averse, but when dealing with losses, they tend to be risk seeking. Now, does everyone agree with that, or does everyone know what that means? In dealing with gains, people tend to be risk averse, but when dealing with losses, they tend to be risk seeking. Yeah, so some good comments coming in there. Yes, absolutely. So, when we are on side in the market and the markets are performing well for us, well, we seem to be quite risk averse because we're jolly, we're happy with our trades to the day. When those turn around and start to look like losers and moving against us, we start to be risk seeking. We're looking to look across different opportunities to see if we can outperform and get what we have lost. And again, to summarize, this asymmetric attitude towards risk can help explain why some investors or traders are unwilling to sell securities that have gone down in value. Okay, so does that make sense? Now, this is just something to discuss. It's not something necessarily to hit home with you, because it's a natural human emotion. If you make a great trade and that turns around, you're going to look to tend to feel more risk seeking. That's a human emotion, but it doesn't mean you should act on it. And that is the focus on mitigating risk across those markets, because if those markets turn around substantially, well, you're going to get out for your winners. Your stop loss is going to be hit. You might not have gained 120 euros profit on the trade, but you might have gained 90 euros on the profit on that trade. That happens in the financial markets, guys. That effectively is what happens across these markets. And that is how we look to trade. Okay, so that's just a point of reference there. The asymmetric attitude towards risk can help explain why some traders are unwilling to sell securities that have gone down in value. Because it's totally human in terms of emotion. You've made 120 on the trade, you want that full 120 back. You're waiting and hoping the market moves up. But guys, let's focus on the consistency, and through the next few lessons we'll be discussing portfolio diversification and developing our own trading strategy, which will be very, very entertaining and enjoyable, and fantastic learning experience to get you ready for trading the live markets indeed. So that brings us on to our lesson summary. What did we learn in this particular lesson? Well, risk and risk aversion are important concepts when modeling how to choose from or rank a set of random variables. It is therefore so important in financial trading, not only because trading is entirely an exercise for monetary expansion, which it is, but because there exists a large range of random variables. Okay. Although we all have different appetites for risks, we are all to some extent inherently risk averse. And of course, you have two traders looking for two trading opportunities. One, perhaps these two opportunities provide 50 euros profit, but one is inherently less risky. Of course, both traders are going to want to choose the one with the least risk association. That is, of course, natural. We are natural seekers of inherently risk-averse trades that do provide income. And the ability to mitigate risk in trading is a coveted skill and takes time to practice and manage. So you can see, I was a hypothetical demonstration of a portfolio of me managing some of those risks on the trades. However, guys, that is going to become common practice for all of you as you go through trading these financial markets together, okay? So that brings us to the end of this Become a Pro lesson with risk and risk aversion. What I would like to do now is, well, first of all, congratulate you. We have now finished webinar 14, guys. 14, almost a full 4 weeks of this Become a Pro course together. I assume the good weather is calling you all out to the great outdoors. So that's absolutely fine, guys. I'll let you go for the evening. Thank you very much for joining us here at Forex.Academy. We'll see you next time. Bye for now.